Welcome back to the deep dive. We cut through the complex corporate stuff, the dense reports, and give you the knowledge you actually need.
Yeah, we save you the headache of reading those long PDFs.
Exactly. Today, we are really drilling down into Fannie Mae's Q3 2025 earnings presentation. We want to understand the real health of this housing finance giant.
And the risks they're watching. It's crucial if you want to get a handle on the housing economy right now.
And we should note, this all comes just as Peter Akwaboah took over as acting CEO after Priscilla Almodovar's departure. So kind of a key moment.
Right, so it's his first report card, in a way, and it tells us a lot, not just about Fannie Mae, but, the whole U.S. mortgage system.
Okay, so what's the big headline? Straight off the bat, it looks like resilience. Strong Q3 net income, despite, well, everything happening with rates and the market.
Yeah, the core business seems pretty sturdy, but when you dig a bit deeper, the year-over-year picture gets interesting because of how the accounting works.
Sturdy, okay. Let's get into those core numbers then. Net income reported at $3.9 billion for Q3. That's up, what, 16% from Q2?
Correct. A solid jump quarter over quarter.
But compared to last year, Q3 2024, and it's actually down 5%.
Yeah.
So what's going on there? Why that drops?
Okay, this is key. That year-over-year dip. It wasn't really about a sudden surge in bad loans right now. It was mostly about changes in something called the provision for credit loss.
Ah, the provision. Explain that for us. What does that number really tell you?
Well, it's basically an estimate. It's what they expect future losses might be based on economic forecasts, things like interest rates, unemployment predictions. It's not about losses happening today.
So if the economic outlook gets a bit brighter, they can lower that provision, which makes net income look better.
Exactly. And if they think things might get tougher down the road, they increase the provision. That pulls net income down. So that 5% drop reflects a shift in their forward-looking risk assessment, not necessarily a current crisis.
Okay, that really changes how you see that number. So while the provision bounces around a bit, the actual foundation looks stronger. Net worth grew, right, to $105.5 billion.
Yep, a very healthy number. And net revenues were pretty steady, around $7.3 billion, basically flat compared to Q2 and last year.
And they calculate this illustrative return on required equity that went up.
It did to 10.3%.
Yeah.
Which signals, decent capital efficiency, even as they're still working towards hitting those full regulatory capital levels we'll talk about later.
Got it. Now, the engine behind all this, guarantee fees. The report says G fees were almost 81% of their net revenue in Q3. That sounds like a lot riding on one thing.
It does, but actually that's the source of their stability. It's the bedrock.
How so?
Because those fees aren't just on new mortgages. They're charged on their entire outstanding guarantee book. That's a massive $4.1 trillion portfolio.
Wow, $4.1 trillion.
So they get fees on almost every loan they currently back month after month. It doesn't totally depend on how many new loans are being written today.
Okay, so even if, say, the market seized up and new originations fell off a cliff,
they'd still have that substantial income stream flowing from the existing book. It provides real revenue protection. And actually, they noted the base guarantee fees are ticking up slightly.
why is that?
As the single-family book slowly turns over, old loans with lower rates get paid off or refinanced. Eventually, they're replaced by newer loans that often carry slightly higher guarantee rates. It's a gradual lift.
That stable base lets them keep doing their main job, right? Providing liquidity. They put $109 billion into the mortgage market in Q3. Is that tough to do when buyers are hesitant?
It shows they're sticking to the mission. And that $109 billion helped over 400,000 households. Think about that impact.
Yeah, break it down.
Well, 207,000 were home buyers, and about half of those were first-time buyers, which is crucial in this market. Plus, they helped keep around 23,000 households in their homes through assistance programs. That's significant volume in a tight market.
Definitely. Okay, let's shift gears to credit performance. You mentioned a diverging story here.
Yeah, it's like two different markets within their portfolio. Single family looks strong, like a fortress, really. But multifamily, that's showing some definite signs of stress.
Okay, let's start with the fortress. Single family, SF. Overall credit looks good.
Very robust. Net income for SF was up 13% from Q2, partly because of lower credit loss provisions, like we discussed, and also better cost control.
But you mentioned something interesting about the size of the book.
Right. This is fascinating for what it says about the broader market. Even though most new loans were for purchases, not refinances, about 80%, the total number of new loans wasn't enough to offset the number of existing loans paying off or running off. So the single-family book actually shrank slightly.
The book is shrinking. Doesn't that point to a bigger issue? Like maybe a lack of affordable houses to buy or people just staying put because of rates, the lock-in effect?
Exactly. It signals that market paralysis. People with those super low mortgage rates aren't moving, which limits inventory, and that slows down new loan acquisitions for Fannie. It shows the market's kind of working against liquidity right now.
Which makes the quality of the new loans they're getting even more important.
Hmm?
You flagged something there.
Yeah, it's something they're monitoring closely. A slight increase in new loans with FICO scores under 680 and also loans with high debt-to-income ratios, or DTI, over 43%.
Okay, higher DTI. That feels expected when affordability is so stretched, right? People have to borrow more relative to their income. But does that mean Fannie is taking on more risk to keep the volume up?
Well, that's the tension, isn't it? Fannie says this DTI trend is kind of baked in right now. With rates high, buyers have to push their DTI limits just to qualify for the payment. They believe they're managing the risk okay through underwriting.
But it highlights the pressure.
For sure. And that pressure likely stays until we see a significant pickup in refinancing.
Did they give a number for that? Like what rate level would trigger more refis?
They mentioned that meaningful refi activity probably wouldn't kick in unless mortgage rates drop below 5%. That seems to be the threshold for the current homeowners locked into low rates.
Below 5%. Okay. And in the meantime, how are they protecting that single-family fortress?
Credit enhancements. About 47% of the SF book, that's roughly $1.7 trillion, has some form of extra protection, like mortgage insurance or risk-sharing deals.
Gotcha. Okay, now pivot to the other side. Multifamily, MF, you said this is where the stress is showing?
Definitely. The numbers here are pointing the other way. Seriously, delinquent loans and non-performing loans in the MF portfolio increased by 7 basis points from Q2. Net charge-offs also ticked up by 4 basis points.
Why is that happening now?
They described it as accumulated pressure from sustained market challenges. Specifically, rents aren't growing as fast as they were, or maybe even softening in some areas, and net operating income growth for these properties is weaker. That makes it harder for building owners to cover their debt payments.
So commercial property stress bleeding through, but like SF, is there protection here too?
Yes, and it's pretty comprehensive. Because of their risk-sharing model in multifamily, nearly the entire MF guarantee book has some form of credit protection built in.
So while the delinquencies show real market pain, high borrowing costs, softer rents Fannie itself is somewhat insulated from the full blow of those losses.
That's the idea. The risk-sharing partners absorb a first layer of losses. It's a crucial structural difference.
Okay, interesting contrast. Let's talk operations.
Yeah.
They seem to be focused on costs.
Very much so. Running a tighter ship was clearly a priority. Total non-interest expenses were down 8% from Q2 and down 10% compared to last year.
How'd they manage that?
Pretty standard levers, really. Lower spending on salaries and benefits, reduced use of professional services, which points to trimming both employee and contractor numbers. They also noted some specific gains from paying off debt early and lower costs related to foreclosed properties. Efficiency efforts are paying off.
All right, this brings us to what you call the aha moment, the capital situation. It sounds complex.
It is, and it's super important to understand. So Fannie Mae has this huge net worth, $105.5 billion, all built up since 2020 through retained earnings. Sounds incredibly strong, right? Like a massive safety cushion.
Yeah, $105 billion sounds like more than enough.
But here's the regulatory twist. Despite that $105 billion, they are still considered to have a regulatory capital deficit of $25.4 billion.
Wait, how can you have over $100 billion but still be short $25 billion according to the rules?
It all comes down to what the regulator counts as eligible capital. Capital that can truly absorb losses in a severe crisis. 2 big items on Fannie's balance sheet don't qualify. The senior preferred stock owned by the U.S. Treasury.
Okay, the government's stake.
Right. And their deferred tax assets, or DTAs, these are worth billions, but they don't count towards the regulatory requirement.
Why not? Why exclude those?
Well, the senior preferred stock is seen more like a claim on the company by the government, almost like a debt from a regulatory capital perspective. And deferred tax assets aren't actual cash on hand. They represent potential future tax breaks. In a major crisis, the value of those future breaks might disappear. Regulators want pure loss-absorbing equity.
So they have the assets, but not the right kind of assets for the regulatory definition. They're technically solvent, but not compliant yet.
Precisely. So they need to fill that $25.4 billion gap, primarily using future retained earnings.
Yeah.
And that's just step one.
Just step one. What's the ultimate goal?
The total target is, well, it's huge. On top of closing that $25 billion deficit, they estimate they'd need a total of around $190 billion in eligible capital to meet their full requirements as defined back in Q3.
Wow. $190 billion. That's hard to even visualize.
It really is. To put it in perspective, it's like needing to retain pretty much all their current level of net income for, maybe 10 years or more, depending on earnings.
Yeah.
It's a massive long-term capital build.
But they did offer some reassurance on their current strength, right? Something about stress tests.
Yes, that's important context. They pointed to their 2025 Dodd-Frank stress test results. Those showed that even with the current capital structure, they could withstand an economic scenario even worse than the Great Recession and still support the housing market.
So the underlying business is resilient, operationally strong, even while they're on this long journey to meet the final regulatory capital rules.
That's the message, yeah. The systems can handle severe stress. The main challenge now is building that specific type of regulatory capital buffer mandated by policy.
It really highlights that regulatory versus operational reality. Okay, let's tie this all together. The CFOs seem to hit two main themes.
Yeah, pretty much. Resilient earnings, thanks mostly to that very durable guarantee business we talked about.
The G fees.
Right. And second, that unwavering commitment to building regulatory capital brick by brick, quarter after quarter.
So for you listening, we've really unpacked the engine of their income, those G fees. We've seen the split personality and credit, strong single family, stressed multifamily, and critically, we've untangled that complex capital situation.
Understanding why they have $105 billion but are still technically short on regulatory capital is key, and knowing the sheer scale of that $190 billion final target.
Which leads perfectly into our final provocative thought for you to chew on. Fannie Mae clearly needs to build this massive $190 billion capital buffer for safety and regulatory compliance. But think about this. How does that absolute necessity to retain almost all their earnings impact their other core mission, providing maximum liquidity and affordability, especially now in this high-rate environment?
Is there an inherent tension there, a trade-off they have to constantly navigate between maximizing safety through capital building and maximizing their support for the housing market?
Something to think about. Is building the fortress impacting their ability to help people get inside?
A question that really gets to the heart of their challenge right now. We'll leave you with that until the next deep dive.